Let's move on to the business valuation theories and discussion. We have three topics to be discussed. First, we talk about stock market analysts. In the stock market, in general, it is divided into two camps. One is the fundamental analyst or fundamental analysis, and the other one is the technical analysis of the analyst. They aim to forecast the future share prices based on different backgrounds. For the fundamental analysis, they believe all the financial and business information that can forecast the share price. So here, what we would like to share is what is fundamental analysis and what is technical analysis. And for fundamental analysis, it is normally carried out by analysts who specialize in a particular industry and service sector. So the analyst has some expertise in a particular industry or in some service sector. So they can have the expertise and knowledge to make a valuation model to evaluate the business. And said they have in-depth knowledge of the particular sector or industry or companies, and they attempt to make the forecast future prospects for the economy, the industry, and then the company. So they base on, for example, like the gross domestic products, the GDP information, the interest rate information, and other economic data. So then they link up these data to the industry data. For example, if the analyst is focusing on the bank, they will look at the bank sector, like to see the transactions activities and also the industrial, the bank sector news and any bank sectors information available to project the particular bank financial performance, and which is the forecasting financial performance in future. So the various valuation models here are used to estimate the value of company shares. And this value is compared with market price to decide whether to recommend the clients to buy, to hold, or to sell the shares in that company. So the fundamental analysts look at those macroeconomic variables or parameters, and also the industrial data to forecast a company's value with different valuation models. Maybe net asset value model, maybe the present value model, or the price earning the earnings model as well. And once they find the price, the price calculated from their models is higher than the market price trading, so they can suggest the clients to buy the shares because they believe the price will finally go back to their forecast models price level. Is the belief, so they can suggest clients to buy, hold, or sell the shares in a company. And for technical analysts, they prefer another methodology to forecast the share price. They base on the past share price performance or movements and plotting all these on a graph, like a chartist. So sometimes we call them a chartist because they like draw graph or draw charts. And this information is then analyzed and used to forecast future prices by trying to identify the trend in prices and or by relying on the belief that the history repeats itself. That is, the past patterns in share price movement will be repeated in the future. The typical example here is head and shoulders. Okay, for example, once a price of share is going up, okay, and then hit the peak, but then dropped after going up, and so finally it dropped again, Let me draw a better chart here. Okay, here, head and shoulders means there's a head here, and shoulders, these two are shoulders. Okay, once the share price is going up, okay, and then may drop in the initial after going up a long time, then it drops a bit, and then it goes up again to the peak. But at the peak, there's no more investor are interested to buy the shares, so it dropped. And once dropped, some participants would like to buy at a relatively low level, so it pushed back again. But the share price cannot be sustained because maybe the valuation is too high, so it dropped again. So in this case, the head and shoulders is once when you find the share price performance showing shoulders first, and then showing the head as well, and the shoulders again, then maybe you are here. So you suggest your clients to sell the shares because based on the historical price performance, it repeats by itself. So you suggest your client to sell the stocks, and they believe the history repeats itself. So so they only look at the charts to explain the share price movement and make the suggestion to clients. Next is about a discussion on the advantages and disadvantages of 3 valuation models, including the PE ratios, dividend valuation model, and the present value of cash flows. And here, about the PE ratios, it has a number of weaknesses. For example, there's no two companies have the same market size, risk, and growth rates or activity. So in other words, when the companies are comparing with the PE ratio, it is quite hard, or there's no guarantee of the companies have the similar size, growth rate, risk, or activity. Okay, so maybe you have to adjust the PE ratio in the industry average for your valuation. And next, the figure used is merely an average of companies which have been recently taken over. So it is only an average PE index, maybe. And PE ratios in part based upon historical accounting information. So because we just mentioned accounting information is easily manipulated, and it does not consider when you acquire a company, you base on the historical PE ratio, historical earnings per share, and you don't consider any synergy for the acquisition or the merger, because you don't care about the future cash flow, so that you ignore any synergy that may occur. And these weaknesses makes the use of comparative PEs of limited value. It means that the comparative PE has the limitation in which you have to do a lot of modification of this ratio in order to get a more appropriate numbers. Next is about the dividend valuation model. It assumes the consistent growth in the dividends and continue with until infinity. So it is not observable for the growth rate in the dividends, and also it is hard to assume the dividend will be paid at a consistent growth rate in future. For the last one, the last point is about the present value of expected cash flows. In theory, it is the best method to value a business. Because it's based on the cash flow generated from the business. However, the unrealistic assumptions, for example, are subject to a considerable margin of error, with the limitations like future growth rate estimation or forecast is not accurate, and the estimates are based upon the present value to infinity of expected free cash flows. A short-time horizon may be more realistic. In other words, maybe you remember sometimes there's a terminal value is required to estimate. Okay, but this for terminal value, say after 7 years of time, the terminal value of company maybe $10 million, $10 million. So you put this $10 million in your discount, in your discount cash flow analysis. But it's very hard to explain why the terminal value is 10 million, using what method, and why you use them, and why you use those assumptions to estimate the terminal value. So it is very hard to estimate a very long-term business based on this present value of expected cash flow models. And last but not least is about the cost of capital. It's a problem to estimate the cost of capital as well, because for example the cost of equity, it is estimated maybe saved by the capital asset pricing model, in which the capital asset pricing model is misleading because it ignores some of it is only a single period model. It doesn't consider about the multi-period in the discounting. And another discussion is about the forms of efficient market hypothesis. As said, we have 3 forms. Okay, weak form, semi-strong form, and also strong form. The weak form of efficient market hypothesis, it means that the share price, the current share price only reflects the past information. For example, maybe 2 days or few days ago information in the share price, and it does not reflect any current or latest information available. So it implies that any study of the trends in the share prices over a period of time cannot help in predicting the share price, the share price movement in future. And for technical analysis, it's not applicable because of there's no trend can be followed. But for fundamental analysis, it may be acceptable because for any price, any information available in the market is not fully reflected in the share price. So if you are working very hard to analyze the information available and see the valuation of the company shares is below what you are calculated based on the information available, then you can mix the profits by buying the shares in the market and waiting for the share price to fully reflect the information available. And for the next one is the semi-strong form. Semi-strong form means it is different from the weak form. It adds that the share prices reflect all current publicly available information. So for instance, the information contained in recently published accounts or any announcement made by the company, then the share price will move immediately to the new price because the share price reflects all information available in the market. There's no time lag. And if the semi-strong form holds, detailed analysis of published accounts cannot help to predict the future share price movement because the share price has already reflect all information available in the market. And it is only possible to predict the share price in future if any unpublished information obtained or known. In other words, insider information is a key concern because those insider has the information available that they can evaluate the company shares based on this information and can buy the shares in the market if the information is favorable to the share price. So any market would like to stop this insider information trading, to set up a lot of regulations and rules to stop it. The last forms in the efficient market hypothesis is a strong form. For the strong form efficient market hypothesis, it is saying that all the current share price reflects all publicly available information as well as all insider information. And if this is the case, then it will never be possible to predict the share price because all the information available and even the insider information is reflected, then the share price cannot be predicted. And this implication of this statement is that there would be no scope of gains to be made on share trading through obtaining of inside or unpublished information. And in the real world, it is not true. Okay, it is not in practice. So legislation has been set up to prevent any insider information trading.